Selling your family home to downsize sounds like a perfect plan until you realize that you just traded years of hard-earned equity for a massive monthly payment. Let's break this down. Right now, according to Census and Realtor.com, a massive demographic shift is happening right now in America. Nearly 12,000 people are turning 65 every single day, and recent reports show that up to 15% of those older Americans are planning to retire this year, with another 23% following right behind them. The standard playbook for these millions of Americans is pretty simple: cash out. But according to data from CoreLogic, the average long-term homeowner in the US is sitting on roughly $299,000 in home equity. And for adults over 60 who have owned their home for decades, that number is often doubled or even tripled. The plan is pretty simple. We're going to sell that 4-bedroom massive house, and then we're going to tap into that tax-free capital equity gain to buy that smaller townhouse or condo. And from there, we're just going to live maintenance-free through our retirement. But the current housing market actually has a downside that we need to be aware of. A massive percentage of homeowners who are retiring are starting to realize that downsizing to smaller doesn't necessarily mean cheaper. In fact, because of hidden structural shifts in the real estate market, moving into the wrong property can actively erode your net worth. So in this video, I'm going to break down 5 of the biggest mistakes that sellers are making right now, backed behind raw data. That way you don't fall into the same trap. Let's start with the most common financial illusion in real estate, and that's buying a downsized townhome or condo simply because you think you can get a bargain on it. You're thinking, perfect, I'll just pay $300,000 for this villa, bank the rest, and everything else is going to be fine. And what most buyers fail to understand is that when you buy in a managed community, you're not just buying real estate, you're actually buying into a partnership through a homeowners association. And right now, HOAs are in quite the financial distress. According to a massive Realtor.com Homeowners Association report, the prevalence of HOAs has exploded. Nearly 44% of all homes currently listed for sale in the US now carry a monthly HOA fee. And this is just up from 34% just a couple of years ago. And if you're buying a downsized condo or townhouse, that number jumps to a staggering 84%. But it's not just that HOAs are everywhere, it's the fact that they're becoming increasingly more expensive every single year. Industry data shows that 91% of community associations across the country reported unexpected massive budget shortfalls due to inflation, skyrocketing litigation, and material costs. And to survive this, 70% of HOA boards have now increased their prices from 10 to 25%. In major retirement metros, these payments are actually eclipsing actual mortgage payments. For example, in Miami and Fort Lauderdale, the median monthly HOA has increased up to $617 monthly. In Naples, Florida, a staggering $711 a month. Now, if you do the math, that is nearly $8,500 a year in mandatory expenses that you have absolutely zero control over. Even worse than that is the threat of special assessments. If an aging community has properly reserved its cash flow over the years, and now it needs, say, a new roof or a parking lot repaved, then they legally just assess the homeowners. That's how HOAs work. And trust me, I've walked into some of these developments where seniors that are living on a fixed income, that have been there for years, that were suddenly handed a mandatory 30-day notice that a structural modification assessment has been handed down, and they are now inclined to pay it. And if you can't pay it, the HOA will put a lien on your property, and from there, foreclose on your home. So when you start to look at new properties, don't just focus on the kitchen. Instead, look at the HOA documents that they're providing you. Ask your agent for a copy of the association's reverse study. Remember this: if the community's reserve funds are below 70%, then you're walking into what we call an equity trap, and you need to be careful. Instead, what I would do is look for independent single-story homes with no HOAs or highly stable historic associations. When you begin shopping for a downsized home, you are quickly hit with a harsh economic reality. Single-story, zero-step homes are in high demand, and everybody wants them. And because the majority of baby boomers are looking for the same style of home, builders know that they can command a higher premium per square foot. So to get around this, what many people do who are downsizing is instead they look for multi-level townhomes. For example, a 3-story townhouse with all the bedrooms up top, the main living area in the middle, and then the garage on the very bottom. And the reason that people do this is because these style of homes are typically about 15 to 30% cheaper depending on your zip code. It looks modern, it feels luxurious, and it seems like a super clean way to preserve your cash flow. But this is a major real estate trap that you need to be aware of. Remember, A home is a long-term shelter for your money. And according to data from the National Investment Center for Seniors Housing, the average age of retirement relocation has actually pushed deeper to 75 years old. A 3-story townhouse can function beautifully if you're 55 or 60 years old, but what happens a decade later when your knees give out, or maybe you have a bad back, arthritis, or mobility changes occur? This is life. These things happen. Suddenly those flights of stairs now turn into an obstacle course that you wish you could have avoided years ago when you made that decision. When your physical layout fails you and you have this kind of home, you are now forced into selling your home. And it's unfortunate, but it happens. And forced sales oftentimes completely destroy any potential equity gain that you were hoping for in the future. Why? Because you no longer have market leverage working on your side. You can no longer wait for the high interest rate environment to pass, and you can't wait for the optimal springtime to sell your house. You have to sell it immediately, and oftentimes that means selling it for a lower price tag because you can no longer afford to live in that house safely. When you do decide to downsize, you need to focus on buying your forever layout. Remember that. If you can't afford a single-story layout in your zip code, then look at moving to other regional areas to where they offer them. Data shows the average retiree move distance is roughly 223 miles, proving that moving a few hours away to capture a true single-level property is far better for wealth retention than staying local and buying a house with stairs you will eventually regret. For decades, the classic retirement plan has been the cross-state migration. Homeowners in high property tax states like New York, New Jersey, Illinois, look at their annual tax bill and realize they've had enough. So they sell, take their equity, and move to tax-friendly states in the Sun Belt. And it sounds like a perfect wealth preservation strategy put into place. But the 2026 insurance market tells us a completely different story. According to the latest State of Insurance report from the Zebra, the national average for home insurance has climbed to nearly $3,000 a year, but the regional disparities are shocking. If your plan is to flee to Florida to escape from income or property taxes, just beware that you are now walking into the most expensive insurance market in America. The average national premium in Florida is astounding. It's officially reached $9,449 a year, spiking over 18% in recent years to massive multi-billion-dollar claims from successive hurricanes. So let's think about the math logically on this. If you're going to save $4,000 a year in property taxes, but your homeowner's insurance jumps to $6,500 a year, your fixed cost of living just went up, not down. Let's analyze this data from Insurify. 47% of homeowners are now actively struggling to maintain their housing budgets due to insurance premium shocks. When you live on a fixed income and you are now hit with a sudden $2,000 increase in insurance premiums, this completely erodes any chance at saving the money that you were intending to save when you planned on moving to this kind of state. So to get around this, never analyze a final destination simply based on its tax rate. You must calculate the true cost of living. Before making any out-of-state offer, call a local independent insurance agent in that exact town. Give them the property address and get an actual underwriting quote for wind, hail, and hazard insurance. If the numbers are going to then bleed your retirement account, you should then look to more inland states like Nevada or the Carolinas, where the insurance premiums are much better. When older people are looking at 55 and older communities, condos, or townhome associations, what they're really looking for is peace and quiet. They want some assurance that the neighborhood is going to remain pristine and well cared for. So this is when they actively reach out to HOAs that are very strict with specific policies. And one of the biggest ones is a 100% ban on renting out any units. On paper, this all sounds great. It means no constantly rotating door or short-term rentals, or even worse, noisy and obnoxious tenants. But from a wealth preservation standpoint, signing a deed with an absolute ban on rentals is a massive equity trap. According to data from the National Investment Center, senior housing and independent living occupancy rates have surged past 91% across primary U.S. markets, driven by an absolute slowdown in new senior construction. Because senior facilities are full and development has stalled, options for older adults face extreme gridlock. If a sudden medical event hits your family and you or your spouse need to transition into a full-time medical facility, your home can then become your primary source for capital preservation. In a flexible property, you could easily just move out, retain the asset, or even rent it out to people. And depending on where you're at, you could potentially rent your home from $2,500 to $3,500 a month, give or take some expenses, and have some actual cash flow coming in your pocket. This rental check that you're getting every month could then help provide stable income while you're in these medical facilities. But if your HOA has a complete 100% ban on rentals, you're trapped. You can't do anything. You can't rent it out to help cover your expenses. Your only option then is to put your house immediately on the market, sell it, and hopefully retain some money from that asset. And if you're in an unfortunate situation where the market happens to be down and interest rates are extremely high, you may be forced to slash the price of your house just to get it to sell. And this is going to leverage out thousands of potential dollars that you've built with equity over years. The simple solution then is to not buy into communities that have zero tolerance for rentals. Instead, look for associations that offer a 10 to 20% rental cap on the entire complex, or communities that have a very explicit medical hardship or estate exemptions written into their bylaws. This is going to help preserve your asset, keep your exit strategy in place in the event something medical does arise. The final mistake happens the moment the downsize has been completed. Homeowners walk away from the closing table, selling their massive house with a large sum of money in their pocket. They then walk into a new, smaller villa, and they decide it's time to customize this villa to their liking. They then take $50,000 to $75,000 of the proceeds that they just made and spend it on commercial upgrades like kitchens, custom open shelving, or tearing down walls to expand and make a primary suite even bigger. But here's the fundamental rule of real estate that you need to be aware of. Your property value is strictly capped by your neighborhood's comparable sales price ceiling. If the highest priced condo in your neighborhood has ever sold for was $350,000 and you buy yours for $320,000 and sink $60,000 of cash into a hyper luxurious upgrade, your home is not worth $380,000. When an appraiser walks through your property, they are then going to look at it and they're going to put a cap on it based on whatever the market data in your area is showing you for comparable sales. And if the ceiling cap is $350,000, they may give you slightly a little bit more, but they are certainly not going to give you the full amount that you just put into your home. In this case, you haven't built equity. All that you've essentially done is stolen from your retirement wealth. Cash that could be earning you interest or providing for your daily life has now been permanently sucked into drywall or stone finishes or other upgrades that you just thought that you had to have. If you ever decide to downsize, keep your cash liquid. If you want to remodel, strictly focus on ergonomic durability and universal designs that helps you live in that home more comfortably. Invest in things like full lower drawers, low maintenance luxury vinyl flooring, or energy efficient HVAC systems. These updates will keep your costs low, protect your health, and preserve your cash in the bank where it belongs. Downsizing shouldn't mean losing control of your wealth. It should mean preserving it. If you've ever been through one of these scenarios, I'd love to hear from you. Drop me a comment. I respond to all of my comments. If you're considering updating your home and you want to know what some of the biggest regrets are that homeowners make, check out this video. As always, thanks for being here, and I look forward to seeing you on the next video. Take care.